You're still watching Lunch Money this Friday afternoon. Joining us now on the markets is Mayuresh Joshi. He's fund manager, Angel Broking. Mayuresh, look at those levels that we're seeing on the markets right now. In fact, we just saw a flash that it said it was early Christmas on D Street. What's your take on where things are headed at the moment?
First of all, Merry Christmas to you and your team, Fatima. So yes, I think Christmas probably is around the corner, but valuations probably looking a tad bit on the higher side. So I think the markets might just move out in range. Again, historical high level, just a theoretical number from the levels that we are currently. But over a period of time, I think corporate earnings as they improve and as more and more constructive activities takes place on the private capex cycle, I think the re-rating of the markets will be evident. But I think for that things, I think probably need to wait for Q3 numbers. So again, markets expected to move in a tight consolidating range, but I think it's going to be more stock specific.
Mayuresh, why don't you come in on what is your understanding on counters like Muthoot Finance and the others in this space, and what are your projections for the next year in terms of how are they positioned vis-a-vis the bigger financing companies and banks, for example?
The gold financing companies had a good run so far on two basic parameters. One, I think the kind of area of growth that you're probably witnessing is expected to continue between 10 and 15% for the two large players. Muthoot obviously is the largest in terms of the gold financing, followed by Manappuram. But again, these two companies are probably doing their value addition through microfinance, housing finance, vehicle finance. Manappuram has actually reached 20% in terms of their overall top line. Muthoot is close to around 10-12, so I think they are also trying to inch that up. And that probably gives them more stability in terms of earnings because of volatility that you can probably see in terms of the gold financing business. Third, again, in terms of the different parameters that both these companies work out of, the yields have probably held up with cost of funds going down. The spreads should probably remain around the current levels. Third, I think in terms of their cost structure itself, because a large element of their cost is fixed in nature, as more business happens in terms of productivity through their branch network, you're probably going to see leverage play out on the balance sheet and consequently numbers for the quarters to come. So even on the price to book parameter, both these counters probably have moved up. But again, there is still some steam left. So yes, I think there is some upside still left on these companies.
Okay, let's shift our focus to Britannia. That's very much in focus today. This is as Motilal Oswal has raised the target price on this counter with maintaining that buy rating that they have. My colleague Harshit Taneja is joining us now with the latest on this. Harshit, just take us through what the brokerage is about this particular counter.
Motilal has given on Britannia to maintain the buy rating, but they've raised the target price to 6100 from 5845. The company has continued its launches in low segment, which is aiding growth. The cream LUPs are expected to penetrate well in the rural markets. The LUPs have led to ramp up of sales without hitting margins. The company has seen rapid growth in distribution and growing presence in weaker states. The company expects huge headrooms from the rural markets. They expect the revenue contribution from rural markets to go up to 35% and 20% in the next 2 years. The company has set up 13,000 new distribution centers across rural markets to cater to this new market. The direct reach for the company has doubled over the past 2 to 3 years to about 1.56 million. The company has also seen significant savings and favorable commodity cost outlook. That is why Motilal expects stable margins over the next 2 to 3 years. Motilal has valued the stock at 48 times its 2019 EPS. Overall, this report is very positive for the company.
All right, thanks for taking us through all of that. Mayuresh, your thoughts? We've, of course, been talking about this particular sector, but Britannia, of course, if you want to say anything about, and also any kind of pecking order in that peer group.
So it looks very, very good. I've always remained bullish on consumption as a theme over the next 3 to 5 years. What Britannia has done over the past few years has been exceptional, both in terms of their cost optimization program as well as the premiumization in terms of offerings. So both these factors have played out very, very positively in terms of volume growth for the company. And third, I think if you want to top it up in terms of the direct distribution reach, that a lot of these FMCG staple companies are trying to achieve, cut supply chain, that probably gives them more leeway in terms of pushing through their products directly through their chains. as well as reducing the kind of lag that we probably had in terms of the receivables. So yes, I think decent volume expected with input cost inflation expected to remain on the higher side. I think as demand catches up, the pass-through in terms of raw material prices going up can definitely be passed on. And that does create the additional leverage that one really needs. Valuation-wise, one might argue that these companies are trading at elevated valuations, but that's always been the case. So I think Emami remains our top pick within this space. Expectations of the company being debt-free over the next 2 quarters. Again, the same story in terms of the direct distribution going up significantly, supplier chain coming down to 42% and going down further over the next few quarters augurs well for the stock. So Emami is something that we'll continue to prefer. Britannia is a clear hold from our side with expectations of earnings trajectory still remaining very, very strong for the company.
Right. Mayuresh, PVR and the likes, this space, how is it looking with any assessment in terms of 2018 and the way the movies are panned out? Of course, Padmavati is something that will release in some time, at least that's the belief of the producers. But how do you see this industry and what are your picks there?
So I was trying to book tickets on BookMyShow for Tiger Zinda and exceptionally high booking rates. So I think yes, the response for Tiger Zinda at least looks very, very promising for movie exhibitors, including PVR. But the content pipeline, as the management was mentioning, looks extremely strong. And if one goes by the premise that Padmavati ultimately gets released in Q4, along with Padman, which is expected to come through at least on the domestic releases, you probably got a reasonable amount of content pipeline. Second, I think utilization levels is something which is extremely critical, and they always remain between 30 to 35 because a lot of shows during weekdays will only run at lower utilization levels. Third, in terms of the key parameters, the average ticket prices have shown a recent increase. So for PVR in particular, in Q2 it was around 204 rupees. Our own expectations is the ATPs should be close to 210, 220, which definitely augurs well for the stock. In terms of the other expenses, which includes the average spending per head on food and beverages, that has seen a significant increase. It was 78 odd rupees that they reported in FY17. That is expected to go up to around 1995 over the next few quarters. Advertising revenue per screen is going up. And at the same time, rental cost and other expenses are going down because of the benefits that they probably receive from input tax credits. So on an EBITDA basis, trades around 14 and a half times. One might really argue that it's close to near or long-term averages. But largely, again, I think the space is consolidating. The number of screens that PVR is adding, along with its close competitors, they've probably got a 3-4 player industries moving forward. So yes, I think remain positive on this space, expecting a reasonable amount of growth to come through on all these parameters.
All right, you are positive on this space. In fact, staying with entertainment, ENIL, that is Entertainment Network India, is trading with gains over 1% after Morgan Stanley has upgraded the rating on that counter from a neutral to a buy. Raj Mehta is joining us with more on this. Raj, take us through what it is that's making Morgan Stanley quite upbeat on this network.
So we Motilal Oswal on Entertainment Network India, and they've upgraded their rating from a neutral to a buy while maintaining the target price at 910. What they're basically saying is that they expect ad revenue to increase from November and December, given that ad revenue was muted in October because of the early festive season and also the subdued Gujarat election ad spends. They believe that there is a revival possible because of the base of November 2016, which was affected by demonetization, and also the recently launched Karan Johar show, which is expected to drive revenue. Also, they believe that new stations will break even by the end of Q4 of FY18, given that capacity utilization levels will increase from 23% at current levels to 25 to 30% range. They also expect the company to spend around 3,000 crores by FY19 towards the acquisition of TV Today and also the Phase 3 auctions, which is likely to generate a revenue of around 70 to 80 crores for the next 2 to 3 years. Overall, they expect the company to report a revenue growth of 14% for the third quarter, and they estimate around 4% revenue growth for the entire year of FY18. They believe that the break-even of the new station will also drive EBITDA growth of around 15% levels. For the next 3 years, they've estimated a growth of around 15% in terms of revenue and EBITDA growth of 29%. And finally, on valuations, they say that the company has been valued at around 20 times its EBITDA level of FY19, and post the recent 15% correction in the stock price, they believe that it is a buy call on the stock with a target price of 910.
Thanks for taking us through all of that. Mayuresh, any thoughts you have on this particular network? We, of course, just went to an extensive range of reasons why that brokerage house is upbeat on them. But are you looking at these guys? Any thoughts there?
There was a clear disruption pattern, Fatima, in terms of ad revenues probably remaining constrained. And when I was reading through annual reports for both the NIL as well as music broadcast, I think though the management remained very, very upbeat, it is going to be a very slow and gradual growth, and that was what was coming out. Largely, again, I think if you look at the industry dynamics itself, a large element of advertising probably comes in also from a lot of local guys. So I think as the disruptive processes will smoothen out over the next few months, yes, I think those local advertisements also will start flowing through, and that is a huge support in terms of a double-digit ad growth for radio companies. The third element also becomes that a large part of the fixed cost is incurred in setting up stations. A large part of the capex in terms of bidding for stations is probably imbibed into the fixed cost element. As new stations start getting in, as they start getting rolled over, I think a large element of this fixed cost gets spread over the revenues for all the new stations that get combined, and that probably curtails and gets down that cost in a significant manner, creating the much needed leverage needed on the balance sheet. So it's going to be a very slow and gradual process in terms of ad revenues growing. But yes, again, I think within this industry, again, I think a basket is still something that I would probably prefer to own. Something like ENIL, music broadcast seem interesting, but you probably need to have patience because they are going to be a very, very slow and gradual return givers from a stock market perspective.
Need a lot of patience and they will be slow return stocks that you let me just get your thoughts, Mayuresh, on this space, the realty sector. It's gone through its own set of challenges. We all have seen how some of these companies have struggled and have not given any value returns to the shareholders. You have some picks in this space. I mean, do you think it's very much like a individual stock story and it's not like all of them in this space are looking weak, but generally realty sector has, because not given that kind of returns that it should have. How are you telling or treating your investors in this space to invest?
So you're absolutely right, and I was hearing the management on your channel yesterday. It was a very interesting perspective that the real estate sector actually throws out. So I think India is a very diverse country, and you probably need to break it up into different regions. So the NCR and the northern parts of the country are obviously burdened with oversupply. And that is the whole intention in terms of inventory levels actually remaining very, very high there. The southern parts of the country, which is more IT driven in terms of demand, did probably get hit because of the cyclical conditions that a lot of IT professionals were going through. The bench strength probably not inching up for a lot of IT companies, attrition remaining extremely high. And that clearly displayed onto the sales numbers and the sales velocity of all of these companies. The third angle in terms of the two disruptive events, so demonetization in GST along with the introduction of RERA, has probably just thrown back a lot of players in terms of realigning themselves as well as customers. So a large part of the unorganized market can probably get shifted to the organized players, which is far more compliant in terms of statutory requirements. And to that benefit, I think selective real estate companies do benefit. Purankar obviously looks very, very interesting from a long-term perspective, but we do like Brigade and we do like Godrej Properties. Sova and Kolte is something that I like, but the stock movement has been tremendous over the past few months. So I think valuation is looking high for those two counters. These three counters and declines probably appear to be far better in terms of the growth outlook and the earnings movement.
All right, Mayuresh, always such a pleasure having you on air. Happy Friday to you right there. Mayuresh Joshi, Fund Manager, Angel Broking, speaking to us right here on Lunch Money. Thanks for that conversation. Still ahead, we are going to be connecting with